Okay, hi guys. Now we are back for the next chapter. The next part of chapter 3. We are going into the details of financial market. All right, so let me just share screen with you so you can see my financial market notes. Okay, now I just want to talk to you a little bit more in detail about financial markets. So, as I've told you previously, financial market is the place or the markets where um, individuals or organizations they will be able to borrow or invest their money. So, what is our focus when we come to financial markets? So, as compared to a financial intermediary, financial market, it will bring direct contact with an investor. Okay, this will allow the investor or the borrower to have direct access to funds rather than having an intermediary. So sometimes when there is an intermediary, you need to understand that there may be a cost involved. So to reduce this cost or to eliminate or to avoid this cost, this is where normally individuals they will go directly to the financial market, right? Now, um, so you need to understand that a financial market will be able to provide organizations or these individuals or the household with short-term funds, okay, or you will be able to obtain longer-term funds from this financial market. Now, as for your information, what is the difference between a short-term fund and a long-term fund? Because normally, guys, just to let you know, students always ask me, Miss, um, how do I differentiate long-term, short-term fund? Is there any other type of period that is involved besides long-term and short-term? Yes, there is. There is long-term, medium-term, and also short-term funds. What you need to remember or what you need to be well aware of is that when it comes to short-term funds, it means funds that mature within a period of 1 year, within 1 year. After 1 year, there isn't any more maturity. You don't hold or you don't hold an investment or you have to return your borrowing. Okay, that is what it means by mature within 1 year. Next, medium-term funds, it matures within a range of 1 year to 5 years. All right. So when it comes to 1 year to 5 years, it's called a medium-term fund, while long-term sources of finance, okay, are those that are more than a period, mature within a period of more than 5 years. All right. So why do you need to know short-term and long-term finance? It's because you will need to understand whether you require that amount of fund in your organization for a longer term or for a shorter term. If you require it for a shorter term, you just need to ensure that you borrow a certain amount of money for a period of less than a year, because you don't want to have a borrowing for 10 years, but you don't have any cash that is coming in for you to be able to pay this amount of money. All right. So you just need to ensure that you match your financing needs, okay, with the term that you require it for. Okay. Then, what is the short term? Where is the short term finance provided, and where is the long term finance provided? The short term finance is provided via the money market, while the long-term finance is provided via the capital markets. So now you already know, or you are well aware about the short-term finance and the long-term finance provided. So money market, I'm just going to highlight this. Hold on. Provides funds for the short term, while capital market provides fund for the longer term. Now, besides the money market and the capital market, your financial market has two further categories, right? Does anyone here know what are the two categories that you have? Okay, so you need to understand that the two categories that are available that the financial market has is primary market and a secondary market. Now, what is the difference between a primary market and a secondary market? So, a primary market is a place where you are able to issue new investors. Okay, new securities to investors. Sorry. Okay, I repeat, capital market is a place where you issue new securities to investors, while the secondary market, so primary market, issue new securities to investors, while the secondary market is a place, okay, where your investors are able to trade their securities with one another. So that is the difference, okay, between a primary market and a secondary market. Let me just highlight it for you guys so that life will be easy for you. Issue new investors, okay. Now, I just want to add this word here, trade. Okay, please also put trade because your examiner normally when he asks in the objective question, he has also used the word trade before. So just be aware of that term, right? Now, so when it comes to money market, what are the classifications? Okay, what are the classifications of instruments that are sold or that are available in the money market? So you need to understand that there are two categories of instruments in the money market. Number one, you have an interest-bearing instrument, and number two, you have a discount instrument. Now I'm going to give you guys 1 minute to think about what is the difference between interest-bearing instrument and also the discount instrument, right? So think about it. If you were to just look at the normal layman term of discount instrument or interest-bearing instrument, I think you will know what it means, okay? Okay, are you all okay? So a discount instrument is an instrument where it is issued at a discount, okay? And at the end of the term, that means when it matures, you will get the instrument back at their face value. That means it is issued at a discount to their market value, and at the point where you are going to redeem this instrument, it will be redeemed at face value. An interest-bearing instrument, on the other hand, is an instrument where you will, when you lend or when you deposit the amount, okay, you will receive interest or you need to pay interest. All right. Now, besides that, what you also need to know about an interest-bearing and a discount instrument. Okay, what else do you need to know about interest-bearing and discount instrument, right? So, you also need to know that there are few types of instruments, okay, when it comes to both the interest-bearing and the discount instrument. So you have, for the interest-bearing instrument, you have number one, money market deposit. It's a bit too small here, guys. I just realized it, I'm so sorry. Number two, you have certificate of deposit. Number three, you have a repurchase agreement. While As part of a discount instrument, you have treasury bills, commercial paper, bankers' acceptance, and bills of exchange. Right? Now, let's talk a little bit more in depth, okay, before I continue about the money market instruments, okay, as in the discount or the interest bearing instrument. Let's talk a little bit more about the primary market and secondary market, because I realize I've not given you an example yet. So, what is a primary market again? A primary market is where you issue new instruments. So the example is, let's say a company A wants to acquire company B. A wants to acquire company B. So what do you do? Normally, let's say instead of you pay cash, okay, let me just draw it here for you guys so that it's clear and it's easy for you to see. You have A, you have B. Okay. Now, let's say A wants to acquire B. So when you want to acquire B, right? Let's say you don't want to pay cash, you use a share for share exchange. Share for share exchange. That means A wants to exchange their shares for a number of B's shares. So what you're doing here is, for a certain number of B's shares, you are giving your shares to the people. Now, when I say giving your share, how do you give this share? Okay, this is where the primary market comes in place, because you will issue your shares as or in exchange for company B share. How do you issue these shares? You will issue it via the primary market, because you're issuing new shares to give to B company. All right. Now, the second example would be the example for secondary market. Yes. Okay. Let's say you already hold a certain amount of bonds. Now, you don't want to hold the bonds anymore because you feel like you have earned whatever interest that you want to earn, and you don't want, and you need the money. You don't want your money to be stuck in the short term. So what you do is you go to the secondary market, you trade your bonds. So you will get back your principal investment, and another investor would purchase the bond for you. So you must understand that instruments, normally they are tradable. The only problem is that sometimes you get to see that if the instrument is not attractive, not many people would want to buy that instrument. And also, I need you guys to understand the misconception that instrument, all of it is tradable. No. Like example, bank loan, it's a debt instrument, okay? It's a long-term debt, but it is not something that is tradable. The reason why it is not tradable is because it is a contractual agreement making one party binding to pay the repayment to the bank. So it's contractually agreed that you are the person who need to pay this amount. Then some students ask me, Miss, then what about the concept of a sorry, I forgot the name, of a guarantee? Okay, a guarantee actually, or a guarantor. Okay, guarantee is the paper that you sign. Okay, guarantor is the person that is providing the guarantee. Okay, so guarantor actually is, they have agreed to take on the responsibility should there be an event where the borrower default their loan payment. You, as a guarantor, you will step in to help overcome this problem by, you will take the responsibility to make the payment instead. All right. So just be a bit careful of that. All right. Don't fall into the trap that all debt instruments are tradable. All right. Make sure you know very well which one are tradable and not. Okay. Now the next one. Let's now finally go into the discount instrument and interest bearing instruments. All right. So when you talk about discount instrument and interest bearing instrument, right? What do you first need to understand? Okay. You must understand that an interest bearing instrument will allow an investor to earn interest and a borrower will have to pay interest. So it is divided into three types, which are money market deposit, certificates of deposit, and repurchase agreement. Now, my question to you guys, do you know clearly what is the difference between money market deposits, certificate deposits, and repurchase agreement? So before you continue to listen to my video, I would appreciate if you can put a pause on this video. Okay, just pause, put it on pause. Try to remember what you have learned in the past and try to fill in the information that is blank here. You see, I've given you one answer, but the remaining is blank, all this. So what I want you to do is, I want you to fill in the blanks here before you continue to watch my video. At least in that way, you will be able to test your knowledge. You will be able to test your ability to understand these instruments better. All right. Now, I'm going to explain to you what is a money market deposit. So, when I talk about a money market deposit, some students tell me, Miss, actually, I understand money market deposit. But at the same time, I feel like sometimes I don't understand money market deposit. So, what is a money market deposit, Miss? So, when I tell my students money market deposit, I always tell my students money market deposit is actually a very short term loan, and the term very is actually important. It's a very short term loan between banks. All right. Why I say it's a very short term loan? Because it can be a 1 month loan, a 2 months loan, sorry, a 3 months loan, a 6 months loan, or it can be for 1 year. But it can be very, very short term loan. All right. So another word or another term for the money market deposit is also called fixed deposit. All right. You must remember that the concept of the money market deposit is when you enter into the agreement. All right. When you enter into the transaction, you already pre-agreed what is the interest rate that you are going to pay or receive, and what are the maturity dates. Okay, so all these are already agreed within the two parties. Okay, I'm not going to say people. Right now, so to make money market simple and money market deposit simple and interesting, okay, it's a deposit, so it's interest earned, okay, because it's a deposit. Now, you need to know that it is a very short-term loan, okay, between the bank and the depositor, okay. Now, what happens here is that when you enter into the transaction, you fix the interest and the principal amount. All right. Now, if that is clear, let's move on to the next part, which is your certificate of deposit. Now, certificate of deposits. What is a certificate of deposit? How is it different from the money market deposit? All right. A certificate of deposit, actually, it is just a certificate to show that there are funds that has been received by the bank. Okay. You also need to understand that this certificate of deposit, the certificate of deposit, it will only be a deposit for a specified term, and the interest that they pay for the certificate of deposit is actually at a specified rate. Okay. You also need to understand that the certificate of deposit can be negotiable or non-negotiable. So what does it mean by a negotiable certificate of deposit? That means when you hold a certificate of deposit, a negotiable CD, it means that you as a holder of this instrument, you have two options. What are the two options that you have? Number one, you are able to hold this instrument until the date where it matures, okay? And until the date where you hold it, the maturity date, you as an investor, sorry, you as a deposit holder, the CD holder, you will be able to receive interest and principal. That means for the period of time where you hold it until maturity, you will receive interest and also principal at the maturity date. Now, as for the second option, the second option allows you to sell this instrument to another party prior to its maturity date, and you will be able to sell this instrument at its market value. Why market value? Market value because that is the fair value where you trade your instruments. All right. Now, so the term of the certificate of deposit, okay, can be for 3 months, 6 months, or also 9 months. All right. Like I said, the term, the interest rate, sorry, is fixed by at the point of when the transaction is happening. All right. Now, the next one. Sorry, let me just write what is a certificate of deposit. The certificate of deposit is a certificate of receipt for funds, certificate of receipt for funds, okay, that is deposited at a bank. Deposited at a bank. Okay, and you also need to know that this would be for a specified term and a specified interest rate. All right. The next one, repurchase agreement. So does anyone here know what a repurchase agreement is? Okay, so a repurchase agreement is actually quite straightforward. Okay, it's an agreement between two people or two parties where one party will agree to sell the financial instrument, okay, at a pre-agreed or predetermined date with a predetermined price. At the same time, you are also agreeing to buy back that instrument from the party at a predetermined date and price. So normally the predetermined date where you buy back this instrument is normally at a later date, okay? And usually when you buy back this instrument, you will buy it back at a higher price than you expect. Okay, so actually it is just a form, another form of a secured loan. Okay, normally it can be in the form of treasury bills or bonds, right? Now, let me just write what is it. Okay, a repurchase agreement is an agreement agreement, okay, between two parties. Where one party agrees to purchase, sorry, not purchase, okay, one party agrees to sell first, then you agree to purchase, right? Party agrees to sell a financial instrument at a predetermined price and a predetermined rate, all right? At the same time, agree to buy back this instrument at a later date and a higher price. Okay, so these are the things that you need to be aware of. All right, you need to ensure that you are able to sell it at a price and you already agree, you already enter into a contract, and at the same time you also agree to buy back this instrument at a later date and a higher price. Okay, that's a repurchase agreement. So repurchase, it's also called a repo. All right, that means you agree to, see the word repurchase agreement, you agree to repurchase the instrument that you sell. All right, it's just typically a bond, right? A bond is the same thing. You sell your bond to an investor, and then at a later date you agree to buy it back. So effectively it's just a bond. Okay, now the next one, discount instruments. Okay, discount instruments. So let's talk about the what it means by discount instrument again. Okay, you must remember, I think this is something I forgot to mention. A discount instrument does not pay interest at all. Okay, only interest bearing instrument will pay you interest, but a discount bearing instrument will not pay you interest. Okay, so normally they are issued at a discount. When I say issued at a discount, that means it is a discount to their face value. It is lower than nominal value. Okay, you will be able to buy it at a lower price than the par or nominal value. But you also need to remember that at a later date, okay, when the institution buys back this instrument, they will buy it back at only a par value. So assuming, okay, let me give you an example. So let's say now the par value of your bond is $100. They issue it at a 20% discount. So now you purchased it at $80. Right? You purchase at $80. Now, this $80 here, right? This $80 here does not pay you any interest. Then you're going to ask me, then Miss, how would I benefit from the discount instrument? You will, because normally in an interest bearing instrument, on a yearly basis, you will earn interest. Let's say $5, $5, $5, $5. Let's say you hold it for a period of 4 years. So you earn $20 of interest, and then you get back your principal. For a discount instrument, you buy it at a discount. So you buy it at $80. At the maturity date, you will get back your par value, which is $100. So effectively, you have earned $20. So isn't it the same thing as your interest-bearing instrument? The only difference is here, you earn one lump sum 20 at the end of the maturity. Here you will earn $5, $5, $5, $5 every year. Okay, so it's the same thing. Effectively, the discount actually compensates for the interest that you will earn. All right. Now, let's talk about the discount instruments. What are the types of discount instruments that we will talk about? Number one, treasury bills. All right, here I've spoken about treasury bills here. I wrote treasury bill. What is a treasury bill? Treasury bill is actually as simple as a government bond. All right, it is just a government bond. A treasury bill is actually a government issued debt instrument. Issued debt instrument. Now, what is the difference between this bond and a government bond? Normally, a government bond, it is a secured bond. That means there will be security. You will have highest level of confidence to invest in a government bond. So when I give you an example of a government bond, I think the Malaysians, okay, you guys would understand, or you would know the Amanah Saham. Yep, Amanah Saham gives you about interest 5 to 6%. Okay, but now with the COVID scenario and all that, it might have reduced a little bit. Yeah, okay, but you must remember that investing in Amanah Saham or government bonds, it pays you very little interest. Of course, because you bear the lowest risk. Low risk, of course, you get a lower return, because when you talk about the risk and return relationship, right? Risk and return relationship, the higher the risk, the higher the return that you will earn. But the lower the risk that you bear, the lower the return that your company will earn. All right. Now, besides that, you also need to understand that this government bond, normally you will be issued with a maturity date which ranges from 1 month to about 12 months. Okay, but for the most part, your maturity period, most of your government bonds are issued at a period for 3 months. Right now, so the property of a treasury bills, okay, it will be issued by a government. It is secured, short maturity dates. Sorry, it's hanging here. Short maturity date. And also low interest. A commercial paper, on the other hand, okay, is similar to a government bond. The only difference is that, number one, it is an unsecured corporate debt. When I say unsecured corporate debt, it means that, number one, it is not secured. The risk that you face is slightly higher. All right. So as a result of that, the return that you earn would also be slightly higher. All right. Then why do I say it's a corporate debt? Because when it is issued by, why is it a corporate debt? Because normally these are issued by large corporations, companies, organizations. Okay, but do not worry, the risk is not actually that high, because even though it is unsecured, the companies that issue these bonds are actually companies with very good credit rating. Okay, they have a good financial health as well. All right, so this bond, the maximum maturity date will be 270 days, but normally the maturity date for it would be about 30 to 60 days. So issued by large organizations, corporations, unsecured, slightly longer maturity. All right. The next one, bankers acceptance. Guys, for some reason, I can't say the word bankers acceptance. If you continue to hear me saying it, please don't laugh at me, because the way I say it is actually quite funny. Okay. When I try to speak fast, I actually can speak quite fast, but then surprisingly, when it comes to this banker's acceptance, I find it a bit difficult to say the word. Okay. So now, what is a banker's acceptance? Now, I always tell my students, whenever you get a term, a financial term, try to think about it in layman terms. So let's say um treasury bills. Okay, if I think about the layman term, it's a bills that is issued by the country's treasury, which is your government. Commercial paper, it is an instrument that is issued by a commercial organization, corporations or organizations, right? Companies. And now bankers acceptance. How do I think about bankers acceptance, or how do I um, rationalize bankers acceptance, right? So bankers acceptance is actually a bill that is guaranteed by the bank. So bankers acceptance, that means it is issued by a company, all right, when they import or they are purchasing goods. All right. So what happens is that this banker's acceptance, or another word for it is IOU, or bill of exchange, all right, is actually issued by the corporation, where the bank will accept the risk of paying in an event where the company will have a default. That means actually, right, the bank is acting like a guarantor here. So normally the bank, when he accept the BA, he is saying, okay, in an event of default, I will help the company pay. All right. So you must be a bit careful, because maybe my question to you guys is, do every bank just simply accept bankers acceptance from any kind of companies or any kind of clients? Think about it. If you are a bank, how would you decide whether or not you want to accept the banker's acceptance? Is it something that you just randomly will accept? Or is it something that you will think about in more detail when you want to accept? All right. Normally, if you have a good standing relationship with the bank, that means maybe you have been a holder of an account in the bank for a period of 10 years, let's say, or your company is relevantly financially healthy, then only the bank will accept this bill of acceptance. Bill of banker's acceptance. All right. If not, bank normally would not, because it is actually a way of saying that, in an event where the customer cannot pay, I am bearing the losses, the payment, the amount, which is actually quite dangerous. In case suddenly the person just abscond, then how? So you also need to understand that this banker's acceptance or bill of exchange, all right, is actually the same thing. It is just a way it's a bill that is issued by a company when the bank accepts excuse me, DBA, they are accepting to pay. You are accepting the obligation to pay. Okay. Or the bank is making a promise to pay, or making all right. So we have covered all the instruments here. Okay, are there any other type of instruments that we will deal with? Yes, there are. Okay, number one, you have derivative instruments. So what is a derivative instrument? Okay, derivative instruments, example of derivative instrument: forward, futures, and options. These are all examples of a derivative instrument, but we are not going to go into the details now because this will be learned in the next topic. Not the following topic, topic number 19 and 20. Okay, you're going to learn about forward, futures, and options under risk management area. All right. And also, you have one element that I think I've not explained it yet, but we will. Sorry. I haven't explained it yet, but I will explain it. Sorry, but I will explain it in a little bit. Okay, when I'm explaining about the capital market. So I just want you to understand the concept of each of it. Okay, how will it be tested in the examination? Okay, number one, examiner can ask you to calculate the interest. Okay, he can give you the values. He can ask you to calculate the interest. Besides that, he can just give you a question to choose. Okay, which one of the following are elements or financial instruments related to the money market deposit? Which one relates to the capital market deposit? Which one falls under the category of money market deposit? Like that. Okay, which one is an example of a discount instrument? Which one of the following is an example of a interest bearing instrument? So these are the kind of questions that will be asked. Okay, it's quite simple, it's quite straightforward. Actually, there isn't much of a complication in this topic. This topic is rather straightforward. The only thing about this topic is that you have so many terms that you have newly learned, you have newly got involved yourself with. All right, so it's not difficult. If you have any issue, I think you can just revise or do more questions, I would say, because it is quite difficult for you to know what would be asked by the examiner. So to be very safe, actually, the way to go is, I always tell my students, please always ensure that you do more questions, because the questions is the one that will help you gain familiarity on what the examiner may ask. If you are not familiar and you go into the exam hall, you might get confused, because examiner sometimes he will purposely put the question, or he will purposely arrange the question in such a way where it's rather confusing. All right, so now let's move to the next one, capital market. Okay, what is capital market? Why do you need to have a capital market? So a capital market actually is a method for a company to raise longer term finances. Literally, when you want to raise long-term finance, you would go choose a capital market. Now, compared to all the bonds, all the instruments on a capital market, which of the instruments of a capital market is of very high risk? Okay, so if I want to rank it based on the creditor hierarchy, so from low risk to high risk, normally, okay, I'm just going to draw it here for you. I'm going to draw it here. Okay, normally for a capital market, okay, I'm doing capital market now. What you will need is the lowest risk would be a bond, and the highest risk would be equity. So I don't want to jumble everything up in here. So we will go to a next slide, maybe a very short, quick slide, video, sorry. to show you or to explain to you more about the capital market. So watch the next video for the capital market. All right. So see you guys in the next video. Yeah.